Hey, I'm Daniel Snyder. This is A Week in Bite. In this episode, we are joined by Jeremy Kokemor from Untitled Capital to get his thoughts on two stock ideas that might be right for your portfolio in this bear market. But before we dive in with Jeremy on his ideas, I want to take a moment to highlight that next Tuesday, October 11th at 2 p.m. Eastern, Mike Saul and myself are hosting a free webinar to kick off earnings season. And we're going over the Seeking Alpha earnings screener created by our own proprietary quant system that highlights stocks that are most likely to beat and miss their earnings. We'll also have time to take your questions, and the link for that will be added to the description. So make sure you grab your spot for that. Now, let's get right into it and bring Jeremy into the conversation to get his thesis on these two stocks. Jeremy, welcome to the show. It's great to have you.
Morning, Daniel. How are you?
Doing very well. So I'd like to kick things off just by kind of asking if you could break down what Right-Tailed Capital is all about, just so our audience kind of knows.
Absolutely. So I founded Right-Tailed Capital with the simple premise that I want to be investing for many decades. I love investing. I want to do it for as long as I can still think soundly. And so it was really the idea to kind of take the money that our family has kind of earned and saved over the years, and invest that and really play to my strengths and have our money compound right alongside any other investors who want to come alongside us and join, again, kind of for the long term and have that longer duration. And the name Right-Tail really appealed to me for four reasons. So first and foremost, Daniel, if you think of a normal bell-shaped distribution curve, I really want our returns to be excellent and to be in the right tail. Secondly, I'm typically going to be investing in higher quality businesses that have proven themselves to be in the right tail or better than their peers or the broader company set at large. And then secondly, there are two kind of personal reasons. Number one, I love the process of how do we all get better over time and move ourselves into more of the right tail, whether that's investing, whether that's health, whatever the case might be. And then lastly, I come from a background where, I didn't have much as a kid when I was growing up and did work study, financed my college education. And so I know what it means to not have much and to have that opportunity to protect and grow someone else's savings and investments over time is an opportunity that I take extremely seriously and one that I'm really excited about.
I love that. I mean, obviously, that's what we're all trying to do, right? We're all in the market trying to find these great opportunities. So let's get into these two stocks that you have kind of sent over to our team here. The first one I thought was pretty interesting because, we're going into the winter and this seems to me like it'd be more of a summer stock. What's this first one?
Yeah, so I thought we'd discuss two today, and what's different about them is one, I think, has a little more economic cyclicality to it, and the other one has much less economic cyclicality to it. But I think with a long-term horizon, both can be fantastic investments. So the first one is a company called Ferguson Corporation, which is a little over a $20 billion market cap company based here in the US that primarily distributes plumbing and HVAC supplies. So it's a really neat business where they have a lot of scale. They're number one or number two in most of their market segments. And like other value-added distributors that I've studied over time, Daniel, they sit right in the middle of a really fragmented supplier base. So they have tens of thousands of suppliers that they buy from. And then they have over 1 million customers. So super fragmented on both sides. And Ferguson can use their knowledge and expertise to really help their customers. And they can use their physical presence and boots on the ground to really help their suppliers and increase their sales effort. So this is a company that's been really well run for a long period of time. And there are a few things that are really interesting about it today. One is, anything that is related to housing or construction, those stocks haven't really been good stocks this year. So you have a fantastic company that has had really high returns on capital. And today it's trading at around 11 or 12 times earnings. Secondly, if you look back at the company's historical financials, it has been part of this UK listed company called Wolseley. And over the last 10 years or so, management started selling off a lot of their lower quality businesses that were based in other countries in Europe and have now focused on their crown jewel US business. And earlier this year, they actually moved the primary listing over to the United States. So they're now based on the New York Stock Exchange. And so you potentially have this interesting dynamic where the company may have been sold by some index funds in Europe, but it's too new of a company in the US to be held by the larger indexes like the S&P 500. So I think that is, one possibility over the next 12 months or so, that this business could get added to one of these larger indexes. And that could be a catalyst for the stock. But the main thesis behind this, hey, this is a business that sits in between a really fragmented customer base and supplier base, has really good returns on capital. A lot of the purchases that their customers make are not completely discretionary. And it's just a really good business over time that probably grows a little faster than GDP, takes some share from the broader industry, which still has a lot of mom and pops, can increase their margins a little bit each year, and then through smart capital allocation, probably grows their earnings in a normal year, low to mid-teens. So if we look out a few years, Daniel, I think you could see a business with significantly higher earnings and some multiple expansion as well. And this could be a really good stock over time.
Yeah, and you brought up the interesting catalyst that potentially could happen. Obviously, it's not guaranteed to get rolled into something like the S&P 500, which we know can significantly move prices as all the ETFs pile in and move the stock price, right? But what would you say to people right now that are saying, well, yeah, but this is HVAC and housing is slowing and construction is slowing down. Obviously, this is probably going to affect the business. What would you say to people thinking about that?
Yeah, I would say, look, if you have a time horizon that is a little bit longer than most, and I think most of the market only looks out, 3 or 6 months at a time. And that's a really, really competitive game to be playing. So I don't know what's going to happen in the next few months, but here's the way I think of it, Daniel. Number one, if the economy ends up being fine, then this business is going to continue to grow really, really nicely. And do quite well from an earnings perspective. And I think the multiple will likely recover over time as well, because today I think we have an above average business that's trading at a below average multiple. So again, if we look out just a little bit further than the rest of the market, that's one scenario that takes it higher. The other scenario might be, hey, we actually are in or go into a worse recession than where we're in right now, right? And so that would mean that the company's earnings probably come down some. And so the way I've thought about that is the company earned about $10 per share this most recent year. So let's say that the earnings per share comes down 25%. Maybe they earn, $8, $7.50, something like that. We still have a very reasonably priced stock trading at a below market multiple. And sometimes a more difficult economic environment for a strong company like Ferguson can actually be a really good thing, right? Because they have a great balance sheet. They should be able to take share. A lot of the mom and pops they compete with, I hate to say it, but they're probably going to struggle more in a tougher economic environment than Ferguson will. So again, with a longer term time horizon, I think a tougher near term environment, would set up Ferguson equally well, if not better, than just sort of a pretty good environment from here.
Amazing. So, all right, we got Ferguson stock, and I like this next one that you also brought to us because they're based out of Toronto, I believe. Correct me if I'm wrong on that. And actually, Seeking Alpha just started covering Canadian stocks this year. So it's kind of cool to be able to talk about this one. Would you mind walking us through what it is and what's your thesis?
Yeah, sure. So the second company is Constellation Software, which is around a $30 billion market cap business. That it was founded about 30 years ago by a gentleman named Mark Leonard, who I think is kind of a once in a generation type CEO. So what Constellation does is they acquire and build vertical market software businesses. So this could be a piece of operating software for a fitness club or for a home builder. It doesn't necessarily matter what industry the software is selling to or the end customer. What kind of matters is that the piece of software is mission critical for that end customer, which makes the relationships that Constellation has with its customers extremely sticky. So when I mentioned up front, hey, this is a business that, the business itself, the underlying revenues and earnings should hold up really, really well in a broad range of economic scenarios. So one, each year, they typically keep over 95% of their customers, which again speaks to just how mission critical the products are. And oftentimes, if a customer leaves, it might be because the customer got acquired by someone else, or possibly maybe a few of their customers go out of business each year or something like that. So it's a really sticky product. Secondly, if we continue to be in an inflationary environment, well, because this product is mission critical and the company is continuing to try to improve its software offerings, this is a business that typically is able to increase prices or sell the customer a little bit more each year that goes by. And it's an incredibly capital light business that has low CapEx. It has negative working capital. And so this is the type of business Buffett always talks about, where it kind of says, like, in an inflationary environment, it's a business that does not have many capital investments to make, that can possibly be, a great performer and really provide a lot of value for its customers. And, why I really like the business, and getting back to the CEO, Daniel, is this company has incredibly high returns on capital. So they are typically buying growing software businesses, but maybe slower growing software businesses than the ones we often hear about in the news. And they pay about 1x revenue. And the businesses typically have 30% EBITDA margins. So they're buying these really good, really sticky businesses. They're out hunting, for all these, small sort of niche software businesses, wherever you might be able to find them. And so if you zoom out, since the company has been public in 2006, it has been an amazing, amazing stock. And over the last 10 years, it's compounded at 30% per year. So it's effectively doubling, kind of a little over every 3 years or so. And over that last 10-year period, revenues have compounded at a 20% rate, and EBITDA is compounded at a 25% rate. So as this business gets larger, I still think we're a ways from this happening, but there's no doubt that the law of large numbers will come into play, and potentially they will grow a little bit more slowly over time. But even if that's the case, I think we have a business sitting here today around a 4 or 5% free cash flow yield that is incredibly disciplined with the cash that it produces for its shareholders. And we should be looking at a business that I think can double over the next 3 to 5 years, even if they grow a little more slowly than they have over this past 16-year period that they've been public. And another thing I'll mention that I think is incredibly rare is, since the business has been public, they have not increased their share count at all, either to do deals or just to compensate their managers. And that is incredibly rare. The only other company I can really think about that typically has this low of shareholder dilution is a Berkshire Hathaway. So again, I think the CEO, Mark Leonard, is just a fantastic steward of our capital, a really long-term thinker, and just really good at generating high returns for our shareholders. So that's another one that I think is a really great long-term investment here today.
So just to clarify with you real quick, Jeremy, you're in both of these positions, right? With both of these companies?
I am.
Just to disclose that. Okay, thank you. So I wanted to actually ask you, so you're talking about Constellation Software. I mean, the metrics you're just reeling off are like so eye-opening and pique interest to me, at least. And I'm kind of curious, with the market, compressing that we've seen this year, and obviously tech is getting hit, and we're seeing tech software companies starting to lay off people and freeze hiring and everything else. Would you expect, or maybe be not surprised, if this company over the next few months start acquiring more companies? Is that something that you could see happening?
I think that's a great point that you bring up, right? So we already talked about how the business is pretty recession resistant overall. But if we do enter a period of time where capital is even more scarce for a lot of the companies Constellation competes with, we could be in a period of time where their opportunity set actually even improves. And that would be a fantastic thing, because Constellation already has a great balance sheet. They produce a lot of free cash flow each year. So it's quite possible that a more difficult economic environment could actually be kind of a better long-term setup and allow them to acquire more companies. Whether that happens in the next couple of months or so, that's really hard to predict. But what I can say is, I know the management team is really focused on it, and that's a core piece of their value proposition.
Awesome. Let's go ahead and leave it there. Jeremy, we really appreciate you coming on, giving us those theses and breaking it down. We can't wait to have you on the program again. You have a good weekend, okay?
Thank you so much. It was my pleasure, Daniel. Have a good weekend too.
Now, Kim Khan is enjoying the day off this week, so we're lucky. Oh, so lucky for us, I should say. We're joined by Jerry Cronenberg, Director of News over here at Seeking Alpha, to bring us this week's Catalyst Watch, and I believe an update on the Twitter poll, if I understand it right.
Correct. We're all anxiously watching for how the September non-farm payrolls comes in, and our poll shows a slight maybe pessimism or maybe lack of optimism. 50.8% of those polled believe that it will come in at under 250,000 job gains for the month, non-farm job gains for the month. Slight edge out of the 49.2% who believe that will be very bullish and over 250,000. I am of the 200 to 250,000 camp. And for those of you who are also wondering, we'd love to get your view on the big question this week. Will Elon Musk eventually wind up getting Twitter, or will he change his mind? You can vote at Weekend Byte on Twitter. We'd love to get your views. We'll announce the results next week. And let's talk about what's going on next week. Number of key things. The earnings season gets going in earnest. We'll get our first read on Tuesday, October 11th, with PepsiCo being a very key consumer stock. And the big thing we'll be looking for is late in the week, on Friday, the 14th of October, we'll get all the big money center banks, Wells Fargo, Citigroup, JP Morgan Chase, and others. That should give us a big read on where we are earnings-wise. On the economic front, we'll get a number of Fed and inflation-related pieces of data. We're going to start out on Wednesday, the 12th, with the FOMC, the Federal Open Market Committee, meeting minutes from its September 20 to 21 meeting, where, of course, they raised interest rates yet again. And another key piece of data will be the September Producer Price Index, also coming out that same day. Expectations are it's actually going to get higher or worse, 0.4% between August and September, for an annual read of 7.3%. We will then get an even more important read, probably the most important of the week, on Thursday, October 13th, when the BLS will release the September CPI, Consumer Price Index. Consumer inflation expectation is that we'll get a little bit better, to 8.1% in September from 8.3% year over year in August. So we'll be watching that closely to see what the Fed thinks of that and where we go with interest rates, Daniel.
Thanks, Jerry. Now, obviously, I got to ask you, because you're in the thick of all this news all the time and watching, obviously, what's coming up. Seems like there's a lot of whispers going around, or maybe not even whispers, but shouting that we're going to see a melt up into the end of the year. What do you think? Is that possible here?
Yeah, I mean, I personally, earlier in the year, you and I talked, actually this time last year or so, I was looking at the charts, and I'm saying we wind up with a 3% gain. I don't know, that might not be right, but if we get past October, we've gotten past September, worst month of the year historically for stocks. October is, of course, the month of crashes. We'll see how we do there. So I think we could get some gain. I personally think it would be what you'd call a bear trap rally, which is a rally within a broader bear market. I'm not very optimistic about 2023. I think we've got a lot of pain in front of us, but we could see a little bit of at least a recovery. I don't know if it gets us to positive or negative in the fourth quarter, but I think we could see some better times in the rest of this year.
Man, well, let's keep our eyes on that. Jerry, thanks so much for the opinion. Jerry, you have a great weekend, okay?
You too. Thank you.
All right. Now, in our final wrap up, just a reminder that we have the free earnings webinar next Tuesday, the 11th at 2 p.m. Eastern. Make sure you grab your spot for that. I guarantee you don't want to miss it with how much research we're putting into this. Now, we had an incredible episode of Stock Market Live this week where we dove into why 3M stock has been absolutely demolished since 2018.
It's also worth noting that that some of the largest product liability awards have been dramatically reduced even after they've kind of come to fruition. So that could also be on the table.
Josh, can you throw up that first slide? Actually, I think people you should break this down because you found this and you sent it over. I want to make sure that people see this on that point. Look at these award amounts, and then they got reversed.
Exactly, right. So it's worth noting that the largest product liability rewards in the history, nearly all of them have been either reversed, reduced by 50% or more, or settled for a much lower amount. So I'm not saying this is going to happen for 3M, but like this has been the historical reality. So for me,
so make sure to check that out if you're into dividend plays or you just like the company. Maybe it's in your portfolio. And lastly, leave us a rating or comment below of this episode on your thoughts about Jeremy's 2 stocks he pitched today. We'd love to hear what you think. And that's all for this week. I'm Daniel Snyder. Have a great weekend, and we'll see you again next week.